Listen carefully, because what I'm about to say is going to sound extreme until you recognize the machine behind it. If the United States strikes Iran directly, everything burns. Not because anyone wants a wider war, and not because diplomats suddenly forget how to talk, but because the global system is built so tightly, so levered, and so dependent on fragile energy and credit flows that one kinetic shock doesn't stay military. It snaps the financial spine of the world. Stay with me, because this isn't a slogan, it's a structural forecast. Once you see the mechanism, you stop asking, will it escalate? Like escalation is a mood. You start asking, what does the system do when its assumptions break? Because systems don't negotiate, they respond. Let's anchor this in numbers so it doesn't feel like opinion. The Institute of International Finance put total global debt near $7 trillion by late 2025. The IMF has described global debt as above 235% of world GDP. And we've already seen what a debt-heavy world does when inflation returns U.S. consumer inflation reached 1% year over year in June 2022, at one of the biggest 12-month jumps in about 4 decades. That happened without a direct U.S.-Iran strike adding an energy shock on top of a world already trained to panic at the word inflation. So here's the claim, stated cleanly: a direct strike does not stay military. Why? It becomes a currency event, then a rates event, then an energy event, then a legitimacy event, because modern empires are financed, not conquered. And when financing breaks, power breaks with it. This outcome is not accidental. It is the next phase of a pattern that repeats across history with such consistency that, once the prerequisites are in place, the outcome becomes almost mathematical. Here's the pattern in 4 steps. Lock it in, because the entire video is built on it. First, a power builds an order it benefits from. Trade routes, security guarantees, reserve currency privilege, alliances, and a story the world agrees to believe. Stability, confidence becomes an asset. The system feels permanent. Second, the power expands beyond what its economic base can comfortably support. It extends guarantees farther, and it funds the extension with credit, explicit debt, implicit promises, and monetary accommodation. This is the addiction. You postpone pain by borrowing from the future. And because postponement looks like competence, the political class gets rewarded for it. Third, a crisis tests the perimeter. A war, a blockade, an oil shock, a banking panic, a currency run, a sudden loss of confidence. The key detail is this: by the time the crisis arrives, the system is so levered that leaders no longer choose between good and bad options. They choose between bad and catastrophic. And because legitimacy is on the line, they often choose escalation, because escalation feels like control. Fourth, the system resolves the contradiction the only ways it can: inflation, devaluation, financial repression, austerity, default, political upheaval, or war, usually some combination. The public learns a brutal truth. The stability was rented, not owned. And the bill arrives all at once. Now I'm going to prove this mechanism 3 times. Not to narrate history like a documentary, but to show you the machine repeating. For a century, Britain's system looked unshakable. London was finance. The Royal Navy protected sea lanes. Sterling wasn't just money, it was trust, trade invoicing, and the assumption that British power backed the plumbing of global commerce. That's step 1, an order that pays dividends. Then, step 2, overextension. 2 world wars changed the math. Britain fought, bled, and borrowed. The empire remained wide on a map, but the economic base under it weakened. Commitments stayed global, but fiscal reality tightened. Meanwhile, the United States emerged with deeper industrial capacity and stronger creditor power. Britain's obligations didn't shrink as fast as its relative strength shrank. That mismatch is overextension. Then step 3, crisis and loss of control. 1956, the Suez Canal. Egypt's President Nasser nationalized it. Britain and France, with Israel, moved militarily. Tactically, they could act. Strategically, the system exposed the truth. Britain was financially vulnerable. The United States opposed the operation and had leverage through finance and currency pressure. Britain faced a choice: continue and risk a sterling crisis, or withdraw and accept humiliation. When your currency becomes a veto on your foreign policy, you're no longer driving the car, you're riding the brakes. Step 4, the outcome. Britain withdrew. And the lesson wasn't about a canal, it was about alignment. The security order and the monetary order must match. When they diverge, markets decide. Now the United States, Vietnam-era deficits, the Nixon shock, and the stagflation spiral. Step 1, setup. After World War II, the U.S. built Bretton Woods. The dollar anchored to gold, other currencies anchored to the dollar. Industrial dominance, creditor strength, and political will backed the architecture. Confidence was earned. Step 2, overextension. Over time, the U.S. expanded domestic programs and overseas commitments while keeping a gold anchor that restricted monetary flexibility. Vietnam costs rose, social spending rose, and an ocean of dollars accumulated abroad. The more dollars supplied to run the system, the more claims built against U.S. gold reserves. The system relied on belief that redemption was possible, but arithmetic tightened the noose. Step 3, crisis and loss of control. By the late 1960s and early 1970s, foreign holders questioned the promise. Gold outflows pressured reserves. The U.S. faced an impossible choice: defend the peg with tighter policy and recession, or break the promise. In 1971, Nixon closed the gold window. That wasn't just a policy shift. It was the system admitting it could not meet its own constraints. Then the energy dimension hit. Oil shocks compounded the monetary shift, feeding inflation while growth weakened. Stability evaporated into stagflation, high inflation, weak growth, rising social friction. That's what happens when an overextended monetary order gets hit by an energy shock. It resets. Step 4, the outcome. Credibility was restored only through pain, tight policy, recession, and a re-architected system. The public paid through inflation, unemployment, and political turbulence. Now Germany, after World War I and the collapse of monetary legitimacy. Step 1, setup. Pre-1914. Germany was an industrializing powerhouse. Strong manufacturing, scientific leadership, rising ambition. Institutions had legitimacy. People believed the system could deliver. Step 2, overextension. World War I demanded massive mobilization and spending. Leaders leaned heavily on borrowing and money creation rather than taxation, because taxation is immediately unpopular while borrowing hides the cost. But hidden costs accumulate. Then, Versailles layered reparations, obligations onto a weakened post-war economy. Whatever you think about the politics, the structural point is simple. Obligations exceeded capacity. Step 3, crisis and loss of control. Early 1920s, Germany entered a feedback loop: fiscal strain, political instability, monetary deterioration. When confidence breaks, money stops functioning as a store of value. Hyperinflation doesn't just raise prices, it destroys savings, contracts, wages, and social trust. People lose belief that tomorrow will resemble today. And when belief collapses, extremism finds oxygen. Step 4, the outcome. Monetary collapse became political radicalization. Institutions lost legitimacy. Society searched for a solution that restored certainty, even at horrifying cost. When money dies, the political center dies with it. Those aren't 3 random stories. They are one machine running 3 times. So let's apply it to the present, step by step, coldly. Step 1, the setup today. The post-Cold War order evolved into a global dollar and security system. The United States underwrites sea lanes, payment rails, and alliance security. The dollar sits at the center of settlement, reserves, and global debt markets. Even countries that dislike it still use it, because the system is deep, liquid, and backed by U.S. power. But this setup has a hidden dependency. It requires an assumption of relative stability. It can tolerate regional conflicts and political drama. What it cannot tolerate is a persistent, high-probability risk of supply disruption, shipping disruption, and uncontrolled escalation, because those things reprice everything at once. Step 2, overextension today. Overextension is not only aircraft carriers and bases. Overextension is the balance sheet that funds the posture. In a world of 345, $7 trillion in debt, asset prices become extremely interest rate sensitive, governments become rollover dependent, and consumers become vulnerable to energy inflation. Layer on deficits, rising interest costs, and political constraints that make austerity toxic. Layer on a perimeter filled with credibility traps, because once you publicly promise deterrence, you narrow your options. You can't back down without paying a credibility price, and you can't surge forward without waking the machine. Step 3, the crisis trigger. A direct strike does not start the chain reaction. It reveals it. It injects escalation probability into the world's most sensitive choke points and into inflation expectations. Markets don't wait for certainty. Markets move on probability. Now picture the dominoes, because this is where reality speeds up. Domino 1, energy risk. Premium reprices immediately. You don't need a total shutdown for oil to spike. Traders price probability, insurance prices probability, freight prices probability. If the perceived chance of disruption rises, especially around the Strait of Hormuz, oil stops being a commodity and becomes a fear index for the entire global economy. And it isn't just spot prices. It's shipping routes, delivery timelines, refinery margins, insurance deductibles, contract clauses, and emergency inventories, and the small clauses nobody reads until they suddenly matter. Domino 2, inflation expectations revive. Energy is an input into transport, manufacturing, and food. Even if the spike is temporary, it hits headlines and psychology. Firms pre-raise prices just in case. And workers demand higher wages just in case. Consumers pull forward purchases just in case. After the recent inflation era, societies are hypersensitive. Central banks lose degrees of freedom fast. Domino 3, rates and credit spreads react. If inflation risk rises, bond markets demand compensation. If yields rise, refinancing costs rise. If refinancing costs rise in a world drowning in debt, stress appears. Corporate defaults, emerging market currency pressure, banking balance sheet strain. This is the moment the war becomes a credit event. Credit events don't care about your politics. They care about cash flow, rollover, and confidence. When confidence goes, the math turns ugly overnight. Domino 4, the dollar strengthens. At first, in panic, capital runs to the deepest pool. But here's the poison pill. A stronger dollar tightens global financial conditions, especially for borrowers with dollar debt. It exports stress, trade slows, default risk rises. Then stress boomerangs back into U.S. earnings, U.S. markets, and U.S. politics. Domino 5, political legitimacy fractures. Energy inflation hits voters immediately. Higher rates hit mortgages, credit cards, and business investment. If markets wobble, pensions and portfolios get hit. Social trust erodes. Leaders become more desperate to appear strong. Desperation is fuel for escalation. Now pause and answer one question honestly. Where, in that chain, do you see contained? You don't. Because the system is designed to transmit the shock. That is loss of control in modern form. Not that generals can't execute a mission, but that policymakers cannot control second and third order effects once probability reprices across trillions of dollars of exposure. It's Suez with algorithms, debt, and instantaneous capital flows. Step 4, the outcomes. If a direct strike triggers sustained escalation risk, the world faces a forced choice between 3 ugly pathways. You don't get to vote this away. The system chooses based on constraints. Pathway 1, inflation tolerance. Authorities keep policy looser than they should to avoid detonating the debt structure while energy prices rise. Purchasing power gets sacrificed. Savings are silently taxed. People call it greed and incompetence. The structural truth is simpler. Inflation becomes the politically easiest form of default. Pathway 2, recession discipline. Authorities tighten to crush inflation expectations and defend credibility. That means higher unemployment, lower growth, and financial accidents in over-leveraged corners. Something breaks. It always does when you raise rates into a highly leveraged system. Pathway 3, financial repression and control. In prolonged security crises, states manage capital, steer credit, subsidize strategic inputs, and pressure institutions to absorb government debt. It starts subtle, regulations, incentives, temporary measures. But the logic is consistent. When free markets can't absorb contradictions, control expands. Now compress the logic into a checklist, because this is the moment your brain clicks. A global system centered on the dollar, protected by US. Security guarantees dependent on stable trade and energy flows. Check. A financial base stretched by extreme debt and rollover dependence with limited political ability to accept short-term pain. Verified. A crisis trigger that raises the probability of energy disruption and escalation, forcing repricing across oil, inflation expectations, rates, credit, currencies, and risk assets. Undeniable. A loss of control dynamic where leaders cannot simply talk markets down because this is not emotion. It's risk models updating across thousands of institutions, managing trillions in exposure. Check. An outcome where the system must reconcile security costs, debt costs, and political legitimacy, and cannot satisfy all 3 without breaking one. Verified. Over the next 72 hours, watch 3 prices: Brent, shipping insurance, and US 10-year yields. If all 3 rise together, the machine is engaged, and the unwind has started already. Now, here's the twist. The strike itself is not the main event. The main event is the revelation that the system no longer has shock absorbers. In a stable era, conflict can happen, and the economy keeps functioning because balance sheets are healthier and institutions are trusted. In a fragile era, conflict becomes the spark that exposes brittleness underneath. That's why "this time is different" is the most dangerous sentence in finance and geopolitics. This time is different because America is exceptional. Exceptionalism does not cancel arithmetic. This time is different because markets are smarter. Smarter markets reprice faster and transmit fear more efficiently. This time is different because technology will save us. Technology can optimize logistics, but it cannot print oil, and it cannot make debt servicing painless when rates rise. So what do you do with this, practically without panic? First, stop consuming geopolitics like a spectator sport. Start mapping exposures. If an event can move energy, it can move inflation. If it can move inflation, it can move rates. If it can move rates, it can break credit. If it can break credit, it can break politics. That chain is your framework. Second, position with humility. This is not about one magic trade. It's about not being trapped on the wrong side of a regime shift. In regime shifts, correlations change. What hedged you last year may not hedge you next month. What always worked can fail at the worst possible time. Third, build a personal risk policy. Liquidity matters. Concentration matters. Time horizon matters. Your biggest enemy is not missing upside. It's being forced to sell at the bottom because you didn't respect volatility. Fourth, watch the signals that reveal which exit the system is choosing. Are policymakers tolerating inflation or crushing it? Are credit spreads widening? Are shipping and insurance costs rising? Is the energy curve tightening? Are central banks talking hawkish while governments expand deficits? Those contradictions tell you what the machine is doing next. And now we return to the single question that tells you whether this becomes a temporary panic or the start of a long grinding reset. Here it is. Does the shock stay in headlines or does it enter prices? Because headlines fade, but once it enters prices, oil, freight, insurance, credit spreads, yields, currency volatility, then it's no longer a news event. It becomes a system event. And system events do not end when the press conference ends. They end when a new equilibrium is forced. So here is the final warning, stated as clearly as I can state it. If the U.S. strikes Iran, the immediate question is not, will it start a wider war? The real question is whether it forces a repricing of the world's most important inputs, energy and money, inside the most leveraged balance sheet in modern history. Because if that repricing sticks, even briefly, it doesn't matter what leaders intended. The system will respond the way systems always respond when their assumptions break. It will search for stability through pain. That is why everything burns, not in the Hollywood sense. In the systemic sense, purchasing power burns, asset prices burn, political capital burns, and credibility burns, until a new equilibrium is forced. So don't look for the next headline. Look for the next stage of the pattern. The pattern doesn't care about your politics, your optimism, or your disbelief. And if you want the next piece, the part most people never see, how the machine was built in the first place, why debt and security became welded together, and what the next stage looks like when markets stop pretending, subscribe right now. Because the people who survive regime changes aren't the ones who guess correctly. They're the ones who understand the mechanism early enough to avoid being crushed by it.